Hey guys, welcome back. In this lesson, we're gonna dive into the NYSETICK, which is probably one of my favorite indicators, especially for order flow, and definitely an indicator that I've been using the longest in my career. It goes back to way early in my career, well over 10 years. I'm still to this day shocked when I talk to other traders that don't even look at the tick index, didn't even know it existed. It just blows my mind. It's a very powerful tool. Even if you're trading a different strategy, whether it's your own strategy, uh, any other strategy than mine, and if you're focused on futures or US stocks, it's something that you may want to look into implementing into your current strategy. It's just extremely powerful, and it can improve any strategy by quite a bit. So simply put, the NYSE tick is a number of New York Stock Exchange stocks on an uptick versus a downtick. If you're not familiar of what an uptick or a downtick is, an example would be, let's say a security is trading at the inside market is 10 even by 10:01. If you were looking to get long, you'd be sending a market order to take the offer at 10:01, and that stock or that security, excuse me, would now be on an uptick. If you're looking to get short, you would hit the bid at 10 even, and that stock or security, whatever it might be, would now be on a downtick. If you ever see on like Market Watch or CNBC, if you ever see on the ticker or the quotes going by, you'll see the name of the company and the price, or the ticker of the company, the price, and it flashing red or green. And lots of times there will be an arrow next to it going up or down, and that's simply all it is. It's, hey, did the last trade occur by taking the offer? Did it occur by hitting the bid? So the New York Stock Exchange has about 2,800 stocks. I don't know the exact number. It does fluctuate. They add new stocks, remove old stocks that don't meet the requirements anymore, but that's kind of insignificant. Just know that it's around 3,000 and you're set. So as an example of how it's calculated, let's assume that in a given market or day, the 1,800 of the NYSE stocks are on an uptick versus 1,000 stocks are on a downtick. The tick index value would at that point be plus 1,000. We're going to look at the tick to provide a real short-term view of market bias. It's only going to be used intraday. It's never something you're going to use for a swing trading strategy or something longer term. Its value is really intraday when you're looking to scalp or day trade. To really understand how we're going to use it, think for a second what occurs during a trend. Let's assume we're in an uptrend. Obviously the stock's going up. What has to occur for the stock to go up? Well, people must be taking the offer, meaning stocks are on an uptick. So you're going to see the NYSE tick going up in an uptrend as well, and vice versa. In a downtrend, you're going to see it going down. But what happens at the end of a trend? Typically you're going to see exhaustion. I'm not talking just a little blip in price up or down. I'm talking about stronger trends that had some legs behind them and have been in place for a while, whether that be half an hour when we're looking at it from intraday perspective, or longer. So at the end of a trend, let's say in an uptrend, typically what happens is you're going to see a blow off top, and that occurs because of the people that are short are blowing out of their trades, and all the people out of greed or that missed out on the move are getting in way too late at the top and are getting long. So when that occurs, typically what's going to happen is you're going to see that blow off, and it's correlating. You're going to see it in the tick because in order to have a blow off, you have to have a ton of stocks in the market on an uptick. And that's exactly what occurs with the NYSE tick at the end of a trend. Same thing in a down move. You're typically going to see a big blow off to the downside. People are going to be getting out of their long positions. Some people will be flipping short. Traders that missed out completely on the move will also be going short. So you're going to see that last gasp down, and that's going to be, you're going to end up seeing that in a tick, and you'll see that here in some examples. The best analogy I could come up with is to think of it as a spring. So if here's our spring, the further, let's say we're in an up move, the further we pull that tick and it goes up and up and up, it doesn't mean that it still can't go further, and that couldn't potentially go all the way 3,000. It just means that it's more likely that it's going to snap back harder the further that string gets stretched. And same thing to the downside. As we're moving down and the tick count's going down and down and down, the further down it goes, the more likely it's going to snap back when it does reverse. So for the purpose of our strategy, and when you're looking to take a setup, you can just make notes of this now. We're going to go over this all of these in great detail when we get into the strategy and combine all the components. But when we're looking at a long setup, we're looking for the tick count to be below negative 200. And when we're looking to go short, we're going to be looking for the tick count to be above 200. And it's that same simple spring mentality or the spring reasoning. We don't want to go when the spring is right here long. We want to go when it's stretched way out so that we have more likelihood of it snapping back. And really, it is super short term, but the one thing that it really helps with is if you wait for the better setups where it's above 200 or below negative 200, what you're going to find is it tends to jump in your favor a lot quicker, which especially for a newer trader is going to make it easier for you to hold on to your position. Next, we're going to talk about tick versus price correlation. You can use the tick count, the spot when a market is potentially going to change trends, by looking at the correlation between tick and price. So to understand that, let's take a look at an example. If we're looking in the green area here, we had a swing low and price rallied up. It went up about 10 points on the ES here. And the tick count went up 1,000. So it's a pretty high, it's a higher correlation than what we're about to look at. So you can see the tick went from, looks about, I don't know, roughly almost negative 300. I guess it was more like 1,100 in the up move, up to 800. And then when we look at it in relation to the correlation in relation to the down move, if we look at it, the down move only really fell about 4 or 5 points, yet tick fell a full 1,000 points. You can see it came right back down. So there's a much higher correlation on the long side. So if I saw this occur in a live market, when we hit this point, it doesn't mean I'm just going to go long by any means, but if I see the setup, I'm going to take it for sure. If I see a setup potentially short, it's probably, there's other reasons in this very given example that I'm not going to go into why I want to take the trade. But if we did get a setup, let's say somewhere in here, short, it's probably a trade I'm going to pass on. I'm going to be only looking to go on the long, take a trade on the long side. Here's another example. If we look at it, the tick went up about 1,600 and price moved up about 9 points versus the down move that you see right here. Tick went down 1,200, almost the same amount of move, and it only moved down 2 points. So what I would be doing if the market was live right now, we were sitting somewhere in here, I'm only going to be looking to take long setups. If the short setup comes along, I'm probably going to pass on it and just wait for a better setup to come. And if you can guess what happened here, you can see price rally. Again, next step, get into your charts. Do not move on to the next lesson until you feel comfortable looking at the tick on your charts. It would also help to look at it in a live market. You guys are going to be able to, at some point, you'll see some of my live trading videos where I actually break things down of actual trades that I take to give you a little bit better idea of seeing it move in a live market. But you need to hop in your charts and get that screen time. It's the most important thing. Don't go on to the next lesson until you've completed these couple of tasks. You're going to want to look for what tends to happen when there is a high tick at high price for the day, and what happens when there's a low tick at low price of the day. And look for a couple of those examples, and then I'm going to give you the answer of what typically happens in the next lesson. And then you're also going to want to start looking at those correlations and see what occurred after. Did the trend continue? Did it reverse? So start looking for those correlations. Again, screen time is key. I can't stress that enough. If you really want to be successful, screen time. It's going to be a little bit of back testing, but a ton of sim testing before you go live. And if you do that, it's going to greatly increase your odds of success. So that's it for this lesson. The next lesson will be hopping into cumulative delta. Remember, go take a peek at what happens at high tick of day at high price, low tick of day at low price, and look at several of them and look at what tends to happen. We'll see you in the next lesson.